Fala, capitalista! Seja muito bem-vindo a mais uma live extraordinária aqui do nosso canal, nosso humilde canal. Hoje fazendo a nossa primeira live internacional em muito tempo, hein? A minha internet não está grande coisa, mas eu tenho certeza que vai ser um evento histórico. Preste atenção, nós teremos grandes ensinamentos. Um dos pais da análise técnica está aí e quem vai fazer, inclusive, boa parte dessa conversa, das perguntas e tudo mais, é o super professor Otavio Fakhoury. Então, vamos recebê-lo primeiro. Uma das coisas que vocês vão perceber é que eu falo muito mal o inglês, não tenho treinado, então a gente vai se divertir com o meu inglês ruim. E às vezes eu vou falar alguma palavra tipo my English is very bad, só para parecer que eu falo inglês, mas vai ser muito divertido. As respostas do super professor Murray não serão traduzidas para o português, mas a gente sabe que a maioria da galera aí entende bem o inglês. Professor Otavio Fakhoury, seja muito bem-vindo.
Obrigado a todos, é um prazer estar aqui de volta. Eu não vou nem falar muito, porque hoje o nosso convidado especial, que está aqui esperando para se apresentar para vocês, eu só quero dizer, eu sou uma das pessoas que segue a análise técnica Elliott Wave já há pelo menos 13 anos. E eu vou dizer para vocês que eu já deixei de perder muito dinheiro por seguir essa modalidade de análise. Então, por isso, por ser um entusiasta e ser um seguidor, que eu fiz essa ponte para convidar, né, o Murray para estar presente. Então, sem enrolar demais, eu quero começar a fazer a apresentação aqui. So, I was just beginning to say, letting people know that how I've been a Elliott Wave follower and practitioner for over 12 years, and I was explaining to the viewers and the listeners that I've probably saved so much money from trying to avoided so many losses just by being able to understand and protect myself using Elliott Wave analysis. So without taking too long, I'd like to introduce Murray Gunn, who is the head of global research at Elliott Wave International, to all of you that are listening. This will be in English. Murray, please talk. The microphone is yours.
Obrigado, and thank you. Your English is far better than my Portuguese, so thank you for doing this in English. Well, it's fantastic to be invited along, and yes, I mean, where to start? Or it's you mentioned the Elliott Wave principle. I started reading Bob Prechter's work in the early 1990s when I first entered the financial markets, and I'd started as an economist. I studied economics at university. Started in the markets in '91 with an economics bent, a fundamental analysis bent, and within probably about 3 months, I worked out that the financial markets don't work the same way as you're taught about at university. If when all the news was good, the profit and loss of a company was going up, balance sheet was excellent. Why is the share price going down, and vice versa? So pretty much instantly, I realized that that I needed to learn something else, and started reading about technical analysis, getting interested in the behavioral aspect of the markets and psychology, and that's what led me down into technical analysis and the Elliott Wave principle specifically.
That's good. So, in order to start, I'd like to provoke you with a few fundamental questions first. I mean, you were beginning to say how the market works, right? So, how does basically the view of causality and your view, the view at Elliott Wave International, of what's your view of market causality I mean, how to explain market action, and why is it that Elliott wave changes around this view of causality, and what makes prices move in the market, and why?
Sure. Well, it's very simple, really. What makes prices move are human beings. There's obviously a lot of chat these days with algorithms and computers, and God, that makes me sound old, doesn't it? Computers. That's been obviously been around for decades, but the fundamental aspect of what makes a price move is human interaction with each other. If you're a market maker back in the old days, if you're a market maker and someone comes in and wants to buy some stock from you, you sell them the stock, and then you're short that stock, so you have to buy it again. And if someone else comes in on the back of that other buyer and buy some stock, then of course the price is going to start moving up. You're going to, as a market maker, you're going to move the price up. So the reasons why prices move are incidental. And there's a great story from the foreign exchange market in the 1980s, a legendary story about a foreign exchange trader who walked into the office one morning in London, and before everyone else was there, and there was a whole desk full of the newspapers and magazines. He was on his own, started reading, and then eventually he started buying the yen, and then his colleagues started drifting in. They noticed that he was buying the yen, so they started buying a bit of the yen as well, the Japanese yen, and of course the price of the yen was ticking up. And eventually the whole of the London market, came in, saw that the yen was ticking up. These guys were buying it, so they started buying it, and eventually the yen, broke through. They made a lot of money. The manager of the trading floor comes out and he says, "So what's going on?" And he says, "The chap who started buying the yen." He holds up a copy of the Economist and he says, "This tells me that the yen is fundamentally, by purchasing power parity, undervalued. Japan's got a huge trade surplus. The US car manufacturers are up in arms. So the yen can only go one way, and that's up." And so the manager looks at the copy of the Economist, and he turns around back to him and he says, "Well, congratulations, you've made this bank many millions of dollars in the last couple of hours by doing this. There's just one thing: your copy of the Economist is 12 months old." So he picked up an old copy and he was reading it. So it doesn't matter the reasons of why people buy and sell. It's just the fact of supply and demand. And that's the causality of things that we talk about. That's why it's irrelevant. Everyone in the markets looks for the famous phrases: what's going to be the catalyst? What's going to be the catalyst? Well, obviously, even the fundamental people in the market talk about things like buy the rumor and sell the fact. So even fundamental people know that prices move. And then when the fact or the economic number or the interest rate cut comes out, then the prices will move back from whence they came. So it's an easy read, and it's easy for the people in general to get caught up in the media, because the media want to obviously, their job is to sell a story. So they're going to be saying, well, the stock market went up today because of interest rates were coming down. But then, the next breath they could say, well, the stock market went down today because interest rates were coming down, because the economy's going badly. So it's really, and we ignore the noise of what's happening. We still pay attention to the news, of course, because the news is sentiment, and that really is something we do pay attention to, but from an opposite way. And maybe we can talk about socioeconomics, later. But Robert Prechter's theory of socioeconomics. But I mean, at the moment, what we're telling our subscribers at the moment, specifically because of all the chaos that's going on with over the last few months, that there's never been a better time just to block out all the noise, all the what people, the media would say, fundamental analysts would say should be catalysts, and focus on the price action, because that will tell us what's happening. And you know, over the last few months, we've had some good examples of that. Classic example is a what we call, I don't want to get into too specifics or too technical because I don't have any charts to show at the moment, but we noticed a couple of what we call triangle patterns in European stock markets, and also in the share price of Tesla. And that enabled us, you know, over at the end of last year and the start of this year for Tesla, to say that yes, the market, these prices will surge higher from this triangle, but given that triangles appear in a certain part of the Elliott wave structure, it will also mean that a rise in price is what we call terminal, and it will end up with a fall in price, which could be quite sharp. And we were telling subscribers this at the end of end of last year, and the start of January. So yes, so it's worked out. It's worked out that way, but of course, the market's a dynamic process, and that's why, you know, I'd encourage listeners and viewers to go to elliottwave.com. I think is it / Roxedo for the special discount or special offer that we've got for viewers here.
Okay, you can send me the link in our private chat if you have a link, so I can get in the email too. We're gonna put the link. Okay, I'm gonna make that.
Then I know that Murray, that you have a special interest in looking at the rates and credit markets, right? I know that you publish a monthly, very thorough research piece looking at rates, money markets, and credit. So tell us about, I mean, we've been getting new numbers every day about the massive amount of credit in the world, right? I think the latest number for fixed income credit, public and private in the world, is roughly $330 trillion of credit, not counting the synthetic credit, the derivatives, right? Just you know, bonds and loans, public and private, $335 trillion worth of credit. And you've been ahead of other analysts in forecast a break in the shift in paradigm. Usually we had, anytime you had a stock market sell-off, you'd get a flight to quality in terms of government bonds, right? Especially 10 and 30-year treasuries. And we've seen a break of this correlation in the last sell-off. We saw, I mean, the 30-year treasuries trading very poorly during the last market sell-off, right? The April sell-off. And this was, I know that this was forecasted. I mean, in your research piece, you know, since February, you're saying that longer dated bonds would not go down in terms of yield. They would not go up in price, and they went down in price with a falling stock market. So tell us about how you were able to forecast that, and how do you see the credit markets today in the world? I mean, I know that you publish it, but how would you sum it up, you know, for the followers?
Sure. Well, yeah. I mean, the first thing we really try very hard not to do is think about correlations, because correlations wax and wane over time.
Break. They're there, and then all of a sudden they're not there anymore, right?
That's exactly right. So that this idea of this inverse relationship between stocks and bond yields over the last number of years has been it's been relatively strong at times over the last few years. But if you look back in history, if you look back on a 40-year history, it's really, you know, the correlation's just not statistically significant at all. So this is why what we do is we analyze each market on its own merits in terms of the Elliott wave structure, the technical analysis of that particular market. We then forecast what that market should do based on our analysis, and then obviously the correlations will fall out of that. Just as an aside to that one, maybe we'll talk about Bitcoin later on, but Bitcoin and the S&P 500 over the last 12 years using monthly data, they have it's a correlation of something like 0.96, I think it is. So, but does that tell us, do we say then, okay, well, if we're bearish of the stock market, we should be bearish of Bitcoin as well? No, we analyze Bitcoin on its own merit. But, ironically enough, both are saying that we're kind of at peaks at the moment. But in terms of the bond market, going back to the bond market you were talking about, yes, I mean, we were forecasting just recently peak in the stock market, and the link between the stock market and credit spreads is logical. If the stock market is going up, companies are being profitable, probably. Therefore, they can cover their debt servicing costs and vice versa. So that's a sort of...
And they can borrow cheaper too, right? If their stock is higher, yeah?
That's right, yes. But I mean, you can analyze credit spreads based on technical analysis as well, and we've done that. Obviously they were at the very sort of lower end just before this recent widening of spreads. I think the investment grade index was at the lowest level, tightest spread it had been at since certainly 2008. And these things it's like volatility in the market. I've always said that there's not a lot of things that are mean reverting in the markets, but credit spreads are, and volatility certainly is.
Yes, it's good to know. People are asking about Bitcoin. I'm going to leave it for later, because if we go into this now, I mean, to me, the amount of questions that people make about Bitcoin and gold, it means that really we're kind of in euphoria mode for both, right?
Professor, deixa eu só fazer um comentário com a turma. Pessoal, não se esqueçam de deixar o like aí no canal, entendeu? Professor Murray tem várias redes sociais, também as redes sociais do Elliott, nós vamos pôr para vocês depois. Tem o link que eu coloquei aí de baixo, /roxo, para vocês irem lá, conhecerem o site, conhecerem o conteúdo, se inscreverem, o pessoal saber que veio daqui de mim e do professor Faca. Mandem para um amigo, isso aqui é conteúdo de altíssimo nível. O professor Murray é uma sumidade em Elliott e a gente acredita firmemente nesse método. Então, quem quer algum papel que ele olhe depois, o professor Faca vai colocar no relatório deles, e ele vai comentar ali o relatório, como é que eles fazem as análises. Então, diga o papel que vocês querem aí, S&P, Bitcoin, nós estamos falando um pouquinho de Treasury, e treinem o seu inglês aí, ponham numa tela grande, desliguem o celular para prestar atenção e escutar o professor Murray, que tem muita sabedoria, sabe muito sobre o mercado. Muito obrigado, professor. Faca, é contigo.
So I'm going to continue with a few more generic questions, and then we'll go into others. One of the things that is very common for us to listen, to hear, is that, well, the markets can go down, but then the Federal Reserve or the ECB is going to come in and bail out, issue new money, bail out. There's the so-called Fed put, right? And then the market will just inflate out of the problem and go up again to new highs. Well, that's not what the Elliott wave patterns, it's not clear in any of the Elliott wave patterns, right? That we're going to be strongly higher. So how would you address this? I mean, people believe this. They have this firm belief that central banks can, bail out people all the time. First of all, do central bank bailouts work? Because in 2008 they started bailing out the market, way before the market went down, right? And this market still went down, 60 or 70%, 60 something percent. And the market just decided, when the market decided it was over, it was over. But the central banks had been, issuing new money and, lending. First they lend, right, at zero interest rates. They just offer free repos to everybody. And it still doesn't work because nobody's confident enough to get all that money and go around buying stuff. And then they actually start buying it outright, QE. And it's still, market still kept on going down until at a certain point, prices deflated and the market, got rid of all that pessimism, got it all out, and then it started moving up again. So how would you describe, how would you explain to followers? I mean, central banks are not this all-powerful, all-powerful entity that can, revert the course of the market. They're just a
Professor Faca deu uma
player, right?
Agora...
And they are a player that, many times trades, Okay, we're back.
Termina, faz de novo o final
How would you...
do Banco Central, o finalzinho, os 10 segundos.
Yes. How would you explain to the people listening that central banks, I mean, are they this all-powerful entity that can, revert the course of the market, or is it the market that reverts itself when it finishes, whatever trend it's following? And a little bit of, or central banks are basically a big market player that many times acts, after the whole crowd has acted or with the crowd at extremes. And then if the market goes down and people are fearful, probably the central bank is going to be fearful too, and it's not going to be as, how would you explain this? I'm going to just translate this question before you can answer. Eu perguntei para ele sobre o papel do Banco Central nos mercados e se o Banco Central tem o poder de reverter o curso dos mercados ou se ele é mais ou menos ele é apenas um grande player que entra no mercado junto com a manada no topo, se ele, na euforia, também opera na ponta do mercado e depois, se o mercado cai, ele... Quer dizer, como é que ele explica o papel do Banco Central? Yes, please.
Well, you've pretty much nailed it in what you've said there, and you used the word confidence, I think, and that's absolutely spot on. That is exactly what it's all about all the time in the markets, and we know this. It all relies on confidence, and confidence can go very quickly. And you're absolutely correct in pointing out the example of the great financial crisis when the Fed and other central banks, but especially the Fed, were trying to help out the markets, cutting rates, providing liquidity, etc. during that period in 08 especially, and the market continued to plummet. And you're absolutely right, it wasn't until March 09 that the market bottomed out. Something which Elliott Wave International actually told subscribers at the time that around that time, that March 09 was probably going to be a bottom in the market. But yes, the whole idea of central banks being this omnipotent kind of godlike thing in the market is just pretty ridiculous, really. It's a modern invention. Obviously, central banks, the Fed was created only 100 odd years ago. Before that, markets existed. Markets functioned perfectly well without central banks. There was internal and external discipline of monetary aspects going on there as well. But if this, just to give you one example, if people think that that central banks can stop the market from falling and lift the market back up, the stock market back up, lift the economy back up, then one word: Japan. I mean, Japan topped out in 1989. The Bank of Japan, yes, economists might turn around, yeah, they made a couple of mistakes, but essentially they were at zero interest rates, for a decade and a half, more than that. And yet the Nikkei really, the stock market, the economy was just slumbering along. And that shows you that, central banks are not this all-powerful player that people think they are. And you're absolutely right as well. They get caught up in the emotion. I remember at the time when the Greenspan Fed was around at it was just before the crash of the dot-com bust, and the people were coming out with an indicator of in the Fed minutes, they were talking about Fed laughter and things like this. In the minutes it would be Greenspan said this, such and such said this, and then there was general laughter. And there's a correlation between the amount of laughter that was going on in the Fed meetings and the level of the stock market. So it's you can get these little snippets of sentiment from everywhere, but it's like the markets. It's like I said earlier on at the start. Central bankers are human beings, and they have emotions, just like every other human being. Yes, they will be fearful when the markets are going down. And another thing, the probably most important thing worth mentioning in terms of central banks, and Elliott Wave International have been showing this for decades in charts, and you can go to the elliottwave.com, so viewers can go to elliottwave.com and see these charts. But if you actually look at the central bank interest rates, such as the Fed funds or the base rate in terms of the UK or whatever central bank policy rate we're talking about, you just have to put that chart up next to a chart of, say, the 2-year bond rate, or a 6-month T-bill rate in terms of the Treasury market, in terms of the US market. And you'll see that the market rates, they move first. So the most recent example, obviously, was that in the last cycle, back in 2020, money market rates and bond yields in the US were moving up, and then eventually the Fed started to raise the Fed funds rate, and they followed the market, and vice versa on the way down. And that happens not just with the US, it happens with the UK, the ECB, whichever central bank you're talking about. Money market rates and short-term bond rate yields, they move first. They lead the central bank into what they want it to do. So this idea, and it always makes me laugh. Every day we'll all watch the financial media, and we're all focused. They're focused on the central banks, and this is where the public get spoofed into thinking that central banks can control the market, because they're saying, well, if the Fed cuts today, then that's going to be good for the market. But the fact of the matter is that the money market rates will have already led the Fed into cutting, but it's only people involved in the market that kind of know that.
No, that's good. I'm trying to pick out some of the charts that you had on your last piece. Since we're talking about bonds, just want you to. Well, that's a credit chart that basically you put out, and those are the credit. That's the United States credit, right? Since we're talking about government, we spoke about treasuries. You would like to make a comment on that?
Sure. Yes. So I showed this chart the other day, and it's the US 5-year sovereign credit default swap which is essentially the cost in basis points of insuring against a default by the US government in the Treasury market over the next 5 years. And as you can see, it's been moving up steadily over the last couple of years, and it's just started to accelerate up again now. And you were talking about the Treasury market action during April earlier on. I mean, it's pretty obvious what's happening in the fact that the rest of the world is losing confidence in the US. Over the last couple of years, we've put out a couple of pieces. One about the reserve currency cycle. And there's generally 100-year reserve currency cycle, and the US is probably coming to the end of that. And yes, just generally, China has been reducing its holdings of US Treasuries for years now, and we've been alerting subscribers to that. That's not a new trend that's been happening. That's been in the melting pot for a while. So the more geopolitical unrest, if you like, to be polite about it, that goes on, then the more it is likely that foreigners will not want to lend the US money in terms of buying treasuries. And that will impact the dollar. Obviously, we've seen the dollar coming off in the last couple of months as well, or last few months. And so, yeah, this trend is underway, and it's something that we were ahead of.
Yeah, that's good. And then the other chart I was going to show is actually the bond market chart, right? Horshu, if you can.
That's
the
chart.
Sure. So this is showing what we call our bond universe, which, as it says there, it's a global aggregate index yield. So it's an amalgamation of the main sovereign debt markets plus the credit markets, emerging markets as well. So the most important thing to realize here, and this is replicated over pretty much all bond market yield charts, is the fact that since the low, which was 2020 or 2021, whichever particular market you want to be talking about, there's such an obvious 5-wave movement higher into again 2023 or 2024, whichever market you want to particular market you want to talk about. But this particular chart here, I think viewers should recognize what we've labeled as a 5-wave movement higher in brackets, and at the top of 5 we've circled A. Without getting technical, that's what we call a primary degree wave A, because the Elliott wave principle is one of the main benefits and the main edges that the Elliott wave principle has, is that it's what we call a fractal model of the market. So waves subdivide into other self-similar kind of patterns. So notice here that on the wave 3 up in this bond yield, that itself, we haven't labeled it, but that itself subdivides into 5 waves, and that's what we'd like to see. That's what we'd expect to see in a particular market which is going to exhibit this sort of action. So, cutting to the chase, the 5-wave movement higher that we've seen here from 2020 into 2023 is important because it's come off obviously a very historic low in global bond yields obviously we had all that period at that time where we had a lot of negative yields as well, but in terms of this aggregate index yield, it was still positive. But the fact is, we've seen a very clear 5-wave movement higher, and that's important from an Elliott wave perspective, because once you see that coming from a very significant low or an historic low, then it's a very high probability that once we get a correction from that 5-wave movement, which we're seeing now over the last year and a half, we've been seeing this correction down. In this situation, we're thinking at the moment it might be a triangle pattern. But once this correction sideways to lower in bond yields is over, because we've seen that initial 5-wave movement higher in bond yields, it's a very high probability that we see another 5-wave movement higher in the bond yield, in bond yields. And so that means that we could be talking in some markets, we could be talking double-digit bond yields, depending on which part of the curve you're talking about. And of course, that would be a huge, for most people, that would be a huge shock. Most people think that we've seen the high in bond yields now.
Yeah. That's going to shock the world, I think, because the free people have been so accustomed to, so used to cheap money, right? And money is not going to be cheap at all, right? So,
well, this is it. It's people. It's a generational thing, and this is why history doesn't necessarily repeat, as Mark Twain said, I think it was, but it rhymes, because it's a generational thing. People forget, people who weren't in the market when interest rates, back in the 90s, when interest rates were at these levels and bond yields are at these levels, a lot of people in the markets over the last 15 years are only looking at bond yields and interest rates being low. So for them, for a lot of people, this is an abnormal period. For people, ancient people like me, who have been in the markets for a number of decades, this is just getting back to normality. This is pretty much where we should be, probably the lower end of where we should be for the time being.
But people like to make a comparison. I mean, if we get a new era of higher rates, I think most people are going to go back to the 70s, right, and compare it to that period. But that period was a very inflationary period, right? We had U.S. in its full capacity of production. We had like a lot of wage pressure, right? And we had, almost a shortage of supply, right? So we had plus credit expansion, so we had inflation. But the next period of high rates, in my belief, is going to be like the 30s, in which rates are going to go higher because basically liquidity problems, right? People are just going to be out of cash, right? So it's a high rate period with a deflation. It's different from what we had in the 70s, which was a high rate period, but with overconsumption. Production capacity was at its fullest, right? And it was a different scenario. Today we have people fighting for demand, right? We have countries trying to export to each other. We have a lot of deflationary pressures coming from all over the world today, right? We have China is now it can't sell to the US, it will have to dump its product in Europe, and because they're facing deflation there, right? They're facing bankruptcies. I heard a lot of banks going down. They're facing, the bond yield there is like historic lows because they're like Japanizing now China, right? And central bank is printing money and stimulating, but they're still having deflation and lower rates like Japan, right? And then they're going to rush to sell their product to Europe because Trump is threatening them with tariffs. So in this scenario, it is a high rate period, but in my opinion, it's going to be like the 30s, because in the 30s we had high rates, but because of defaults, because of too much credit and no cash to pay it, right?
I think that's an excellent point, because at the moment what's happening, we were just talking there about the bond yield chart. There's a very similar chart in commodities. If you look at the commodity
I
indices.
have a commodities chart for you. Let me see if I can put it. Your chart of commodities. If I'm just going to bring it here.
So that would say that, and just while you're getting that up, I mean.
Yeah, I got it. I'm going to get it for you, but you can go. Yeah. Here's commodities, I think. Try this one. Yeah, this is commodities. This last one, Horshu, that I'm putting there. Yeah.
Okay.
The PPP chart. Yeah, let's show it. I'm pushing them directly out of global market research. Yeah, there it is. No, the other one, not Bitcoin. Leave that for later. Yeah, that one, commodities.
Yeah. There we go. Yeah. So I've been kind of fighting. We've all been fighting a losing battle over the last few decades, because people talk about inflation or deflation, and immediately, because we're so conditioned by the media and governments, to be fair, to think about that in terms of prices. But actually, the strict definition of inflation and deflation should be about credit and money.
Yes.
Okay. But in terms of this chart here, this is telling us, very much like the bond yield chart that we had there, a clear 5-wave movement higher from the low in 2020 up to the high. We're having the correction against that 5-wave movement. So it does say to us, from an Elliott wave perspective, that after this correction is over, there should be another movement higher in commodity prices. So that'll probably mean higher consumer prices. Consumer price inflation, if you want to call it that, that would be higher consumer price inflation. But I think you're absolutely right. On the other side of the coin, because the Elliott wave analysis that we're looking at is also very bearish of the stock market.
Yes, show the stock market chart, Hoshu. The world stock market chart that's there.
Okay.
Number 14 VTGRNF, yeah. So he can talk. Yeah, that's the world stock market.
Yes, this is the world or the Vanguard. I think the ticker is VT, but the Vanguard Total World Stock Index ETF is very similar to other indices. The fact that we're seeing a top, or with our analysis suggests a peak at the moment. But yeah, to the point you were saying, that so we could have a situation where if commodities are going to go higher, which it looks like they are on the Elliott wave principle basis, you'll have higher consumer price inflation. But if the stock market is going to go down, you'll have credit or debt deflation, where you're absolutely right. And to use the 30s analogy, you have defaults spiking up, you have companies going bankrupt. We're already seeing lots of downgrades coming through in looking at credit spreads, relationships. So you see a lot of stress in the corporate bond market, a lot of debt deflation. People have to write off their debt, and at the same time, probably higher consumer prices. And maybe at that stage, people will realize that yes, that there is a difference in terms of the I'm being semantic now, but inflation and deflation, it's not just about prices; it's about credit and money. Yeah.
Yes, I mean, if you cross both charts, the stock market and the commodity index, there is a C wave, right, to come in commodities, in which they go down at first, along with the stock market. Yeah, but then once they start bailing out, they start doing all these schemes to bail out, print new money and bail out, they're going to kind of soften. The credit is still going to continue, keep on going the way it has to go and deflating, but then I think there are things that people really need to buy, like food, metals, or whatever the people really need to buy for industrial metals. That's where that's the price. I think after this first round of new money that's going to be trying to offset deflation, that's going to move into things that people really need to buy. So I think that would be responsible for the next leg up in commodities, while credit keeps on deflating, maybe.
Oh yes, yes, yeah. I think it's going to be interesting if we're correct, and the stock market does continue to decline. Then, obviously, the first thing the central banks will do is try and lower interest rates, and of course, they're, like I mentioned earlier on, they're already just following. I mean, the UK cut today. They're just following what the short end of the bond market's doing. There's 1% of cuts already priced into the Fed funds futures strip over the next year at the moment. So yeah, if the stock market continues to go down, they will cut interest rates. I'm not so sure whether they will reopen the taps again on QE or in trying to increase the money supply, because I think perhaps mood, the way that social mood is going, I think social mood might turn against that this time.
Yes.
They might find that the central banks, maybe start to increase the money supply, start to inject liquidity. It was Ben Bernanke that talked about throwing money from helicopters if everything went bad. And of course, they didn't throw money from helicopters at the time of COVID, but
they have it in a way, right? I mean, in order to throw money from helicopters, they need the federal government, right? They need to print money and buy government debt so government can send out checks, right? That would be the checks are like money from helicopter, right? What they did in 2020, right? But in order for that to work, you need someone in the government to agree with it and then do more deficit. And then you have a negative mood and people are trying to cut deficit and have to cut, especially if rates go up. They're going to have to cut. They're probably going to default in a few obligations, right? Governments, because of hard times to finance, right? So
yes, no,
it won't be that easy to throw out checks, right? It's easy to throw out checks to people when you get 1% rates and you can sell bonds easily. But to throw out checks when rates are 10%, that's going to be a lot harder, right?
Well, that's it, and also it's a mood thing as well, social mood. At the time of
the mood
COVID,
is going to make rates go higher, right? The negative mood is going to make rates go higher. People lending less money and holding more onto their money. That's why rates are going to go higher.
Yes, when they did the helicopters or the through the door postman through the door check, we should call it. Social mood was still in a place where consumers would go out and spend that money.
Yes.
I think mood is changing now. Certainly, that's what the Elliott wave analysis is telling us, that mood is going into much more of a negative trend now. And that might mean that if they do go down that route of sending checks out again or trying to, give free money out, then people will just hoard that money.
Yes, they're going to hold on to it like they did in the beginning of 2020, right? In the beginning of 2020, when the pandemic started, the U.S. savings rate went higher because people were holding on to money. Then once the mood improved, they start spending again, and the savings rate went down again, and we know how it ended now. Everybody owing billions of dollars in credit card, billions of dollars in student loans, billions of dollars of mortgages, and now they're like up to here with loans, with debt. But the other chart that I think that the next one I want to show is I think the Bitcoin chart, right? The people are asking about it, right? Because there's this whole idea that Bitcoin is going to be, the safe haven of the world, whatever happens. And I'd like to ask you, what does Elliott Wave tell us about Bitcoin?
Well, I mean,
the Bitcoin chart is here.
Okay.
Yeah. No, next one.
First.
Next one. Yeah, there it is.
Well, perhaps the first thing to say about Bitcoin is that people who were subscribing to Elliott Wave International back in 2011, I think it was when
Yes.
we were writing about Bitcoin.
Yes, I remember that piece. I remember that
Being
piece.
an interesting aspect. And so, yeah, we were pretty much ahead of the game. Elliott Wave International were ahead of the game in terms of flagging this up. But what's really interesting is the way it's developed over the last, obviously, 14 years or so. It's from an Elliott Wave perspective, it's just absolutely tremendous, the way the waves have developed, because it's almost like it's such a pure market of speculation, that the Elliott waves come out the chart at you. And so what we're looking at here in this particular chart, this is only since 2014. It's obviously on a log scale, because doing it on an arithmetic scale, it would look a bit like this. Yeah, I mean, what we are suggesting from our analysis now is that the recent top was the end of the 5-wave movement up since the Bitcoin inception. And so that means that there's probably a big correction to come. But what's incredibly interesting about the top at that 109.12, haven't looked at it in the last couple of hours. Presumably we're not anywhere near that at the moment, but that 109.012 top, that came on the exact day that the new president took office on his inauguration. And of course, that was the new president's been touted as being the, in inverted commas, crypto president, be very crypto friendly. And so getting back, kind of reverting back to what we're talking about news and do we use news causality and things like that. We use causality in a different way, in a contrarian sort of way here in this instance, is the fact that yes, the mood was so buoyant, people were so bullish about crypto that even the US government was cheering about it and going to promote it, and it's absolutely appropriate that if this top does last, which we think it will, that it occurred on the exact same day as the president's inauguration.
Okay, and it's being tested today, right? We have Bitcoin today at $102,000 today. So,
well, this is it, and like I said earlier on, there is that correlation between Bitcoin and the S&P 500. So, what is Bitcoin? Is it a currency? Is it a store of value? That's what people want you to think it is. But if you look at the correlation with the S&P 500 at 0.96 or something like that over the last 12 years, then all you can say about Bitcoin is it's a pure speculative asset.
yeah.
And in bear markets, which we think we're in the stocks and here Bitcoin, what you normally find with speculative assets is that the bear market rallies, the corrective advances against the downtrend, they can be quite sharp. And so that's what we're seeing at the moment.
Yes. All right. I think. I mean, from the questions I had, we've had all, but we might take a few from the people who are watching. Roshu, do you have any? There's some from my Twitter. So. One question here from a reader. I mean, we've covered it already, but I think it's interesting to ask it. What are the warning signs in the U.S. and global credit markets, considering the tightening of credit conditions and credit default spreads, and how might this impact businesses and consumers?
Well, I mean, the main warning sign, as far as we're concerned, would be the Elliott wave pattern in the stock market, because that suggests that the stock market is going to continue to go down, which would suggest that businesses are going to become less profitable, which would suggest that they will have less, ability to cover their debt. So that's really the sort of main aspect to it. As you said, there are a lot of debt. There's lots of debt in the market at the moment. What is also worrying us is the fact that a lot of the credit facilities, a lot of the high yield borrowers over the last 2 or 3 couple of years have started really going in quite heavily into private credit. And if you look at the growth of private credit over the last 2 or 3 years, that's again a worrying sign of perhaps a bubble. And they're even starting to launch private credit funds now, ETFs, and so that's a worry, because obviously these loan deals that are embedded within these funds that now the public are going to be investing in, they're very opaque, and they're very illiquid. So when things start to go badly, which we think they will, what people will find is that they can't actually get out of these funds, because there will be no price. There'll be no price for the loan, for the underlying loan to be sold at. So things value will just disappear. And that, getting to your point about the 1930s, that's when that whole credit market aspect will start to unravel.
That's good. Thanks. I actually forgot one thing. I mean, I was going to ask a question about gold, because people are now also, anytime a market moves parabolically, everybody starts paying attention, right? So I'm going to put the gold chart up here, and let me show where the gold chart is. There it is, a weekly chart. I just went to look for a weekly chart of gold.
O professor Faca vai colocar agora o gráfico do ouro, né? Muita gente perguntando sobre o ouro. O professor Murray já analisou vários ativos. Vou pedir para o professor Faca dizer mais ou menos qual foi a essência aí da conversa toda.
Coloca o de ouro aqui, ó. Isso. That's Bitcoin, gold weekly. There's a weekly and then a daily chart as well. But I think weekly is okay. The question is, okay.
É esse aqui mesmo, professor?
Yes.
GSP, sim.
Não, mais um. Go.
Mais
moving here. Yes.
Como é que tá o nome dele?
É o último, Gold Weekly. Yeah.
É esse aí? Legal.
Okay. And then the question that they asked me, what's the impact of geopolitical tensions and economic uncertainty on gold prices in the US? And to what extent is it still seen as a safe haven asset in May 2025? Actually, again, I know that the answer is going to be referring to the wave patterns, but I'm just reading the question the way it was made. So,
sure. Yeah, I mean, well, to answer the question, it already has been the sort of safe haven, if you like, and it gets back to what we were talking about earlier on about the prices. Financial market prices move very much before the news comes out. So the gold price was moving up, fantastically already. We were alerting subscribers back at the end of 2023 that the gold price was about to explode higher, and that's exactly what.
Yes, I remember the call in October of 23 on the wave C low right there. I remember Bob Proctor making a special report about buying gold.
Yes. The power of the Elliott wave analysis. But yes, at the moment, it does look like we've had this top in the market, which speaks to the downturn in commodities. The chart that we had earlier on, that wave C in commodities. Obviously, gold itself can move separately from general commodity indices. That's why we analyze each commodity and metal, on its own merit. But this particular chart, as Bob has alluded to in a recent, Elliott wave theorist that he was writing about, speaks to this aspect perhaps of debt deflation that's coming through. So in that situation, most values should decline. Be that property, gold, art, other collectibles. Everything should decline in that regard. And under the 1930s conditions, you can still have that happening whilst consumer prices are moving higher, as we chatted about earlier. But this particular wave analysis would suggest that gold, in terms of store of value, it's been proven to hold its store of value over the very, very long term. And in a bear market, I remember the famous Richard Russell. He always used to say this of the famous Dow theory letters. He always used to say, in bear markets, it's the winner is the person that loses the least. So it becomes a relative game. And so if you think about it in stocks, we're looking at the fact that European markets should probably outperform US markets, and probably gold on the way down will probably outperform other
Yes.
Markets.
In other words, gold will go, not in nominal terms, it will go down a lot less than everything else, right?
That's right. Yes.
Yeah. That's good. I think that if there are any more questions people want to make.
Pessoal, vocês querem fazer mais alguma pergunta? Eu queria perguntar pro professor Faca qual foi a impressão dele, quais foram as novidades. Eu sei que o professor Faca sempre lê os relatórios produzidos pela Elliott, né, que é a instituição aí que mais séria, que representa, né, essa escola de análise técnica. Então, professor, conta um pouquinho aí como é que foi, o que ele contou aí pra gente.
Sim, eu vou fazer. I'm going to make a brief summary in Portuguese of what you've shared with us today, Murray. Então, fazendo um resumo, né? Primeiro, ele contou. A gente vai colocar isso para traduzir, né, Roxo?
Vamos sim.
Vamos traduzir isso por IA na voz dele, né? E também em colocar a transcrição em subtítulos também, né? Então, primeiro ele contou um pouco da história da análise técnica da técnica de fazer análise pelas ondas de Elliott, né? E por que basicamente estuda as variações de preço de mercado, são variações endógenas ao próprio preço, né? Não existe influência externa, e sim é uma variação que decorre do coletivo de pessoas que está ali comprando e vendendo, né? Então isso e por isso que tem um padrão tão definido, né? Porque você tem uma movimentação de seres humanos que ora estão eufóricos, ora estão em pânico, e, na maioria do tempo, não estão nenhum dos dois, né? Eles estão ali transitando entre um e outro. E isso afeta preço e afeta também os fundamentos da economia. Quando você tem otimismo, você compra ações e você expande a economia, toma um empréstimo, abre um negócio, arrisca, né, a montar um negócio e tal. E quando você está num período de se contrair, você gasta menos, faz poupança, não quer investir em nada, poupa, não quer tomar empréstimo. Isso produz a recessão, produz até em casos extremos uma depressão, né, contrai as coisas. Então, isso ele explicou no começo, e depois ele explicou sobre o fato das pessoas entenderem o Banco Central como todo poderoso, e fez ali rememorou em 2008 que o Banco Central não foi o todo poderoso em 2008, porque eles começaram a intervir no mercado ali no começo, no meio de 2008. e o mercado caiu durante todo o período de intervenção. O Banco Central fazia uma intervenção, dava uma subidinha, depois caía mais ainda. Então, ele fez toda a intervenção em 2008, colocou dinheiro e o mercado continuou caindo até 2009, até março de 2009. March of 2009. E só ali, quando o mercado terminou sabe, os mais pessimistas terminaram de zerar o que eles tinham, é que o mercado achou seu fundo, né? Inclusive, foi um dos fundos que o Robert Prechter também pegou, né? Eu lembro que eu não assinava o Elliott Wave na época, mas eu depois fui acessar o histórico e eu vi uma publicação ali pegando aquele fundo, né? No dia anterior ao fundo, né?
Fenomenal.
Não é fácil fazer isso, mas ele conseguiu fazer isso lá e conseguiu fazer no petróleo também. I'm reminding the people watching us that besides the low of 2009, Bob also nailed the high in oil, 2008. I remember that piece as well. So it's not easy, right? Sometimes you have to catch a falling knife is not that easy, but sometimes you can make some beautiful forecasts. Às vezes você consegue acertar assim, de forma maravilhosa os fundos e topos. Não é sempre, mas tem uma grande chance, a chance aumentada de acertar os fundos e topos quando você analisa os mercados dessa forma. E aí ele passou o Murray passou a olhar de mercado por mercado, mercado de crédito, explicando que nós estamos num momento onde o crédito está excessivo, né? E olhou para os mercados de renda fixa do mundo, nós estamos entrando num período de altas taxas, né? Pelo primeiro indicador de movimento das taxas foi de alta, porque você teve daquela mínima de 2020 até o 2024, nós tivemos um movimento de tendência, né, de 5 ondas, que a taxa abriu demais, e nós estamos corrigindo para seguir abrindo mais um movimento de tendência. Então, muitos mercados vão ver taxas de 2 dígitos, né, que ninguém espera por isso, mas é o que a análise de Elliott aponta para isso, né?
Perfeitamente, pessoal. Então é exatamente aquilo que eu e o...
Olhou para o mercado de bolsa, né, como um possível topo, e olhou para o mercado de commodities como um fundo para depois seguir subindo, né? Então, assim que você tiver um período deflacionário, as commodities vão subir muito depois disso. E é isso. Vai beneficiar o Brasil, né?
Perfeito. Pessoal, foi extraordinária a participação aí do professor Murray. A gente gosta, é muito fã dele, né? Todos os acertos, né? O quanto uma análise pode ajudar a gente a fazer uma alocação adequada. Nós estamos, né, em plena lançamento do Carteira 360, que é o nosso treinamento mais completo, que explica todo o passo a passo do mercado financeiro, como dominar. E um dos temas, um dos passos é buscar valor, e análise técnica e as ondas de Elliott são extraordinárias, fundamentais. Nós teremos aula com o professor Faca lá, ensinando para a gente, preliminarmente, para os primeiros passos para fazer análise técnica com Elliott. Mas vou fazer uma previsão aqui, hein? Eu acho que nos próximos meses, quem sabe 1 ou 2 anos, nós podemos trazer o professor Murray também para dar uma aula magna para a gente nos nossos treinamentos. Depois a gente vai traduzir para ele o que nós estamos falando. Então, deixa o seu like aí, siga o professor Murray. Ele tem LinkedIn, ele tem X também. Tem o Instagram do Elliott, que nós repostamos lá os nossos stories, fizemos um post junto, collab. Então, acompanhe de perto o professor Murray, porque vocês não vão se arrepender. Sigam também o professor Faca em todas as redes sociais, no X, ele é extremamente ativo. E também veja os nossos programas no domingo. Nós temos de novo o Giro da Semana. E não se esqueça, assista. Na terça-feira nós fizemos a escalada, estamos com o curso, o treinamento 360 aberto. Na descrição desse vídeo tem lá o link. E olha, elliottwave.com/roxo para vocês se inscreverem lá, conhecerem o conteúdo da elliottwave.com, que é, de fato, a sumidade aí sobre quando o tema é Elliott. Não é isso, professor?
Isso. Eu vou até colocar, eu vou colocar nas minhas redes esse link. I'm going to provide the link to the special offer from Elliott Wave International at www.elliottwave.com/roxo, right? That's the link. I'm going to post it. I'd like to, leave the microphone open for Murray's, farewell and last comments. If you want to, actually, if I've forgotten to say anything that you want me to emphasize about the special offer, about your service, about your company, I'd be glad. Now is the time.
Right. Well, thank you very much. It's been a pleasure to have a good chat about the markets. As I said, we're not short of things to talk about these days, which is great, and long may it continue. I would encourage the viewers and listeners to go to the website elliottwave.com. You mentioned Robert Prechter's famous calls back in 08 and 09 and 07, but there's a lot more of that and Robert's history of stock market calls over the decades, and EWI colleagues calls as well. So the evidence is on our website about how we've managed to add value to our subscribers. So I would encourage the people to go there, and it's been a pleasure, and I'm looking forward to maybe doing it again sometime.
Yes, it'd be great if we could do it again. I know it's pretty late up there in Scotland, right? So I'd like to thank you for staying for this long, staying awake, and we would be a pleasure if we could sometime in the next few months, repeat this. And maybe someday, something we'll take a few people, in a tour somewhere. We can have a seminar, with the presence, with your presence, here or maybe there.
It's be great.
Perfect.
Thank you, and thank you very much. We're gonna again. Vou avisar a todos que no meu X eu vou colocar ali o link para quem quiser entrar. Tem uma oferta especial para quem quiser subscrever. Tem bastante conteúdo gratuito também, né? I'm going to also say there's a lot of free articles at elliottwave.com, free material, and a special offer. Tem uma oferta especial no elliottwave.com/roxo, para quem quiser conhecer. Eu recomendo porque eu sou suspeito para dizer, porque eu sou assinante há pelo menos 12 anos, e se eu não perdi tudo até hoje, foi porque eu estou conseguindo ganhar mais de entender.
Frequentemente eu vou almoçar com o professor Fakhoury e ele me traz prints dos relatórios do Murray e do pessoal lá da Elliott.com. Então sigam lá, vale muito a pena. Gente,
eu espero todo mês para ler o relatório mensal do Murray sobre... I'm saying that I anxiously wait every end of month to read the global markets money and rates research, and it's one of the great pieces. The two that I like the most, I like Bob's commentary and the global rates and money markets, which is actually is my background. I'm from fixed income and money markets desk, right, and currency. So your piece is what reminds me of when I used to work with it, and what we used to watch, plus the technical side, which is what I never had back then, and I have now. So, eu estou dizendo que o research dele me faz lembrar do período que eu trabalhava em mesa de operações, em tesouraria, em renda fixa, porque traz aspectos, né, do mercado, comentário do mercado, aliado com análise técnica também. É isso. Thank you very much, Murray, again, and sorry for this. Basically, it's 11:20 p.m. there, right? So.
Oh, it's fine. No problem at all. Thank you very much.
Thank you very much.
Obrigado.
Obrigado.
Fenomenal. Gente, muito obrigado a todos. Um grande abraço para todo mundo. Thank you, Murray. Muito obrigado, professor Fakhoury. Um grande abraço a todo mundo. Uma ótima quinta-feira à noite. Amanhã, sexta-feira, temos papo de opção. E domingo temos giro da semana. É só o começo. Um grande abraço e tudo de bom.